Welcome back to Lamb's Cryptoverse and our version of Jackson Hole, Wyoming. The Fed has a huge job to do, and part of that job will be how the Federal Reserve and all its governors communicate its message out to people. The Fed right now, or actually for over the last year, has been asleep at the wheel and needs to catch up by consistently raising rates. They've got to get that genie back into the bottle, that genie of inflation, and that's a difficult job indeed because they were late. So they need to create tighter and tighter liquidity and use that as a wrecking ball, not just to wreck the economy, but to hit and wreck the whole world. Because if you don't have tighter liquidity, you're not going to be able to lower inflation. And already you've seen lower US dollar reserves all over the world, especially in emerging economies. And right now, all the economic data is strong. I had expected some surveyed economic data to show weakness, but we haven't seen that yet. The only spot of weakness has been in housing and in the S&P Global Composite of ISM data. Basically, this is the S&P's version of the ISM PMI data. That's shown weakness, not just here, but overseas. Some inflation data, however, cannot be changed. And this is data produced by the COVID-19 bottlenecks, deglobalization, stubborn wage growth, and higher energy costs. Remember, the higher energy costs are due to two factors. One, low investment from the previous decade, and two, the more recent Ukrainian war. And we saw what's going on in natural gas prices in Europe, which are just skyrocketing. So consequently, during tomorrow, Friday's Fed address at Jackson Hole, Wyoming, the Fed's going to have to continue calling for higher Federal Reserve rates. They may not say the exact number, but I think it's going to be between 50 and 75 basis points in terms of the increase in the federal funds rate. But what the Fed will do tomorrow is they're going to continue to call for tightness in liquidity. So where the dominoes going to fall? As I mentioned earlier, emerging markets are going to be the first place to fall. You're already seeing weakness in Sri Lanka, Hungary, and larger emerging markets like Pakistan and Egypt. These countries are seeing dwindling US dollar reserves, and they're needed because they're not just needed for imports to pay for imported goods, but they're also needed to pay off external debt. We're also seeing weakness in Europe, right? Because Europe is where, especially Germany, is where you're seeing exports to China. And you know that China has very, very strong weakness, or they have weakness, I should say, in economic growth. And the best examples of that is their real estate market, which is crashing. And as I mentioned earlier, they also have issues with energy prices because they don't produce their own energy. They import most of the energy prices, most of the energy. And some of that's now coming from LNG because you saw the pipelines coming from Russia into Europe and Germany have been either cut or reduced. So how's this all going to affect capital markets? Well, the Fed's continuing tightening is going to affect capital markets in a big, big way. Number one, stock prices are going to eventually decline. Number two, crypto prices and Bitcoin prices are eventually going to decline. And number three, you're going to see high yield spreads rise. And lastly, you're going to see real estate pricing starting to decline. But real estate, as you know, is a lagging indicator. So you're not going to see real estate prices decline now. It's going to be later this year or next year. What you're seeing now in real estate is lower demand. So lower unit sales of said real estate. But you're not seeing the prices decline. So you're seeing a trend here. Everything's starting to decline. So be careful out there, people, because it's going to get rocky. So just to repeat everything I said earlier, At the Fed's Jackson Hole meeting tomorrow, the Fed chairman, Jerome Powell, is going to say that he's going to continue to tighten. He's not going to give the basis points increase that he's going to do, but he's going to talk about the need to continue to tighten because of stubborn inflation. And the second point I wanted to tell you is that this tightness in liquidity is going to eventually cause capital markets to suffer. And that means lower Bitcoin prices, lower stock prices, and lower junk bond prices. Well, thank you all for listening at Lamb's Cryptoverse here in our version of Jackson Hole, Wyoming.